Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Applied Digital Corporation quarterly report. Applied Digital Corporation offers a range of digital infrastructure solutions to high-performance computing and artificial intelligence industries in North America. The company operates through two primary business segments: data center hosting business and HPC hosting business. The data center hosting business provides infrastructure services to crypto mining customers, allowing them to host their operations on the company's data centers. Additionally, Applied Digital Corporation offers GPU computing solutions for critical workloads related to AI, machine learning, and other high-performance computing tasks. In terms of physical infrastructure, the company designs, constructs, and manages data centers to support high-performance applications. This includes a lease agreement with CoreWeave for an additional 150 MW at its Polaris Forge 1 campus in Ellendale, North Dakota. By providing these services, Applied Digital Corporation enables businesses to focus on their core operations while relying on the company's expertise in digital infrastructure management. Overall, Applied Digital Corporation provides a comprehensive suite of digital infrastructure solutions that cater to the needs of high-performance computing and artificial intelligence industries. Applied Digital Corporation market capitalization of $8 billion is materially smaller than most of its industry peers of roughly $17 billion. Applied Digital Corporation trades at a higher price-to-book ratio of 5.35 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 66% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of various business segments. On the growth side, a significant increase in net sales by 52% from 2025 to 2026 is notable. Additionally, gross profit saw a substantial rise of 122% during the same period. The HPC hosting business was another key contributor to revenue growth, with revenues increasing to $71 million for the 3 months ended February 28, 2026, and $182.3 million for the 9 months ended February 28, 2026. Tenant fit-out services, base rent, power pass-through arrangements, and other ancillary revenue streams also contributed positively. Furthermore, the company's at-the-market sales agreement and Series G convertible preferred stock issuance generated significant gross proceeds of $196.4 million and $740 million, respectively. These influxes of capital likely played a crucial role in driving revenue growth. On the decline side, the cloud services business saw a notable loss of $52.2 million for the 3 months ended February 28, 2026, with revenues declining by $18,087 and $53,207 for the same period. The data center hosting business also experienced a decrease of $21.3 million due to the recognition of a gain on classification of held for sale in the previous year. In conclusion, while some business segments saw significant revenue growth, others experienced declines. Understanding these drivers is essential for making informed decisions about future investments and strategies. Net income and profit margins underwent significant changes between the 3 months and 9 months ended February 28, 2026. Initially, net income decreased by $3.2 million during this period. However, when comparing absolute values, it is evident that the company experienced a net loss of -$101,932 in 2026, which is an improvement from the previous year's net loss of -$35,555. The reasons behind these fluctuations are multifaceted. The reclassification of cloud services business from discontinued operations to continuing operations had a significant impact on the company's financial performance. This change led to the exclusion of cloud services business results from management's evaluation of long-term operating performance. As a result, net losses through February 28, 2026 were reported, contributing to the decline in profit margins. The overstatement of profit margins in the past for data center hosting business also played a role in these changes. Despite the challenges faced by the company, including net losses and low or negative profit margins, management is likely evaluating long-term performance without considering the cloud services business results. This approach may provide a more accurate representation of the company's financial health. Despite an initial indication of a decrease in net cash used in operating activities, further analysis reveals that the company has indeed been generating positive operating cash flow. This is evident from the statement on page 80, which explicitly states that the company generated positive operating cash flow for the 9 months ended February 28, 2026. The significant proceeds received from various financing activities and debt repayment also contributed to this outcome. The company's debt level and interest expenses have undergone significant changes over the past year. The total liabilities have increased from $1,236,365 to $3,679,372, while long-term debt has risen from $677,825 to $2,594,501. This substantial increase in debt is evident in the outstanding debt, which has grown by approximately $1,916.7 million from May 31, 2025 to February 28, 2026. The company's interest expenses have also seen a notable rise. Non-cash interest expense increased from $11,515 to $74,989, and interest paid jumped from $54,855 in 2025 to $93,455 in 2026. The significant increase in debt levels and interest rates has likely contributed to this change in interest expenses. Overall, the data suggests that both debt level and interest expenses have increased significantly over the past year. The company's performance can be analyzed through its various business segments. The data center hosting business and HPC hosting business were the standout performers in the 3 months ended February 28, 2026. The data center hosting business reported a revenue of $37,542 with a segment profit of $13,859, while the HPC hosting business generated a revenue of $71,008 with a segment profit of $17,565. On the other hand, the cloud services business struggled to make a profit, reporting a significant loss in both the 3 months and 9 months ended February 28, 2026. The company's performance in this segment was particularly poor compared to the previous year, with a loss of -$24,919 in the 9 months ended February 28, 2026. In comparison to the previous year, the data center hosting business saw a decline in profit from $57,181 to $35,852. However, it is worth noting that the cloud services business was previously classified as held for sale and discontinued operations, but has since been reclassified due to a contribution and exchange agreement on February 28, 2026. Management is emphasizing the company's focus on its core operations, specifically the data center hosting business and HPC hosting business. This strategic shift is expected to drive the transition to profitability, which is contingent upon successful operation of these businesses. In terms of financial outlook, management is confident in the company's liquidity for at least the next 12 months. However, they anticipate an increase in general and administrative expenses as well as operating expenditures due to expanding operations. Additionally, significant investments in property and equipment are expected throughout fiscal year 2026. The company has made several significant acquisitions and divestitures in recent times. In terms of acquisitions, the company has expanded its operations through various means. One notable acquisition is the purchase of Polaris Forge's campus data center facilities, which includes 3 separate locations: Polaris Forge 1, Polaris Forge 2, and Delta Forge 1. This move is expected to enhance the company's infrastructure and capabilities. The company has also made several acquisitions through consolidation, including APLD HPC Topco 2 LLC, where it emerged as the primary beneficiary. Additionally, the company exercised warrants for common stock in CoreWeave warrant and MAM warrants, further increasing its equity stake. The Building 4 lease warrant also granted the company the option to acquire common stock at a predetermined price. On the divestiture side, the company has sold off certain assets and businesses. One notable example is the HPC hosting business, which was novated and assigned to APLD HPC Topco LLC. The company also sold 112,500 preferred units for $112.5 million through Topco 2. Furthermore, a proposed business combination with EKSO Bionics Holdings, Inc., was announced for the cloud services business. The company has also recognized losses on certain assets, including a held-for-sale classification loss of $59,650 and abandonment of assets losses that varied in amount. However, it did record a gain on the classification of held-for-sale of -$24,616, indicating some offsetting gains from divestitures. Overall, these transactions reflect the company's efforts to expand its operations while also streamlining its portfolio through strategic divestitures. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid preferred stock dividends over the past 2 years, with amounts ranging from $1,558 to $4,705 in various quarters. These payments demonstrate the company's commitment to returning value to its investors. In addition to dividend payments, the company has also engaged in share buybacks. In 2025, the company repurchased shares worth $31,342. Furthermore, during the 9 months ended February 28, 2026, the company redeemed a significant number of preferred stock shares, including 20,000 Series E preferred stock and 296 Series M-1 preferred stock. These share buybacks aim to increase shareholder value by reducing the outstanding share count. Concerns about inventory buildup and supply chain disruption are indeed present in the current scenario. One major concern is the potential for power or equipment failures, which can halt production and lead to a backlog of orders. Additionally, labor shortages and workforce challenges can further exacerbate this issue, as manufacturers struggle to meet demand with reduced staff. Furthermore, delays or denials of entitlements or permits from public agencies and utility companies can also disrupt supply chains. These permits are crucial for the smooth operation of manufacturing facilities, and any holdups in their issuance can lead to production delays and inventory buildup. That concludes the financial summary for Applied Digital Corporation. Feel free to comment below, and I will be happy to answer them when possible.